This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization. Michael Parsons Trading Institute presents Balanced Dynamics, the video series. Disclaimer required by the CFTC: the trading of any financial instrument is risky and can cause substantial loss, including the trading of futures, stocks, mutual funds, or options. The use of stops may not limit losses to the intended amounts. Only risk capital should be used to trade futures, stocks, or options on futures or stocks, or mutual funds, or any other financial instruments, whether in conjunction with this product or otherwise. All investments and trades carry risk, and you ultimately make all trading decisions, and you are solely and individually responsible for the decisions and the results of those decisions. Past performance is not indicative of the future results. Not all trades were executed in the actual markets, and the impact of the results can be over or understated. The results and sources are believed to be reliable, but no assurance is made for accuracy or completeness, and is subject to change without notice. You must be aware of the risk and be willing to accept them in order to invest in any financial instrument, regardless of the market. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy, sell any financial instrument. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed in any of our trading materials or websites. In other words, if you risk it, you can lose it. Balanced Dynamics, video number 3, Understanding Wave Flow, Inverses, and Volatility. Inverses and what they mean. Inverses are natural phenomena that occur when a wave changes direction. Inverses are, in essence, targets that have been turned into balance points. They occur because, typically, smaller waves are forced to change their direction in order to match more powerful, larger waves. Naturally, inverses impact our future price projections, requiring some adjustment in how we look at future projections that we've made. Inverses, of their own accord, imply a strong market bias. And as such, inverses provide powerful trading opportunities. A wave behaves much like that of what you see an ocean wave. It moves up and down if all things are equal, having a similar distance and height and depth to create a certain pattern. But because there are so many waves within the market, you will have a change in the direction and how it proceeds when impacted by larger or stronger waves. For example, if you took the same wave and applied a higher, larger, inclining pattern of a wave, the pattern would then have to adjust accordingly. Rather than moving level, it would be required to move upward, even though it may still move up and down. At some point, that move may be so great that it requires the actual pattern to flip. So what would become a high actually becomes a low, and it moves higher to adjust. This is in essence what an inverse is. The market, because it is unable to retract and continues to move higher, is forced to flip over and create what's called an inverse. That inverse is where the market changes direction. A low becomes a high, or a high becomes a low, and the market continues a similar distance. Just as this pattern rises up a certain level, it continues to rise up the same distance immediately following it. That doubles the distance to which the wave will move. It is in essence responding to the much stronger wave that's existing in the market. It has to. It's forced to do so. When we look at a wave pattern on a market chart, what we see is an up and down motion like this, high to a low to a high. But in reality, a wave pattern is, well, it's not quite like this. The fact is, if we could look at that wave pattern straight on as it's coming toward us, what we would see is not just an up and down motion, but in reality a spiral, a circle that's constantly coming toward us and in effect creating a tunnel with its highs and lows, and a lot more happening in between. This fact is not apparent on a market chart, but because we know that this is how the waves behave, we can take a look at a wave pattern from another perspective and get a better view of what's actually happening. If we look at a wave pattern as it is, a circle, such as this blue circle, we can see that it's very easy to visualize that it's going to tend to circle around at a certain level, creating a situation where it has a price high and a price low. But what happens when you put it in a larger wave pattern, such as this red circle as we see over here? Well, to accommodate that, you have to make an adjustment, because this wave pattern will also want to continue with its pattern a certain radius, a certain high, and a certain low. Obviously, this is quite different than our smaller wave pattern or wave circle. So rather than circling around to meet itself again and maintaining a certain price level, it has to flip over or inverse in order to accommodate that change. Now, there's a couple of things we can glean from this diagram that we see here. The fact is that when a larger wave pattern levels out, as it will at the top or bottom, well, typically there's no inverses that will occur. Why? Because it's more than level for a longer period of time. Where the inverses typically occur is when the market or wave pattern is making a lunge toward its opposite side, whether higher or lower. So typically, when you have a trending situation, that's where you will find the inverses occurring. If you have a consolidation, well, typically, few, if any, inverses will occur. Now let's look at our diagram we had before, but with some target lines added. If all things are equal, and nothing is impacting the wave or causing inverses, well then the target lines will in fact give us the highs or lows that form. The accuracy can be rather dramatic. But put that in another situation where a larger wave pattern is impacting a smaller wave pattern to such a degree that is creating an inverse, and what do you see happening? Well, typically the target itself is only a stopping point, and the market will tend to inverse or flip over. The result is that the inverse becomes not just a target, but rather a balance point, and often can be used to target the next point or level that the market's going to move to, by simply doubling the distance from the prior low or high. So in essence, an inverse becomes a balance point. Inverses will occur in approximately 1 out of 7 targets. But the fact is that it depends on the market condition. If you're in a trending situation or a consolidation, well, it's not likely you're going to have inverses. They're just not inclined to occur in such a situation. In a strongly trending situation, well then inverses are more likely to occur. And obviously that makes sense. If a market is moving higher or lower at a rapid pace, well, you're going to have inverses repeating one after another, particularly in regard to smaller waves. Obviously, though, that in whatever market condition you're dealing with, and whatever the situation may be, it certainly helps to know how to recognize when an inverse is occurring and when it isn't. Obviously, that's going to make a difference in your trade and your ability to make full profit out of any potential trade. So what are those characteristics that we would look for? Well, many of those characteristics we'll be discussing and showing examples of later on. But there are some simple factors and some clear indicators that you can use right now. When we look at the typical action of price to a target line, what do we normally see? Oftentimes what you see is price will come up and slightly exceed the target line, but then quickly respond and return back to its original side. It sees the target line as, in essence, a support and resistance level, and so it respects that. Now, the action can vary considerably, particularly in regard to market bias, something we'll talk about later. Sometimes it will have a tendency to wrap around, jumping from side to side, but later on show or demonstrate that it comes back and favors to one side. Or it may simply just bounce directly off the line itself. In any event, if price is going to respond off the target line, you will see it moving away from that target line in some fashion. This is the confirmation that the target is actually in place. An inverse, well, it's slightly different. What we typically see on an inverse is just the opposite. Price will tend to move beyond the line and use the line of itself as a fence or a border to give it a launching pad to continue higher or lower as the case may be. Sometimes it will rise up to the line and actually jump over it, creating a small gap, or just blow by it in fast order. Oftentimes, the market will come back down to the line and bounce off it before continuing higher or lower. Again, the evidence is that the market is using the line as division, and in essence is showing or demonstrating which side it favors. This is the key. Look at the subtle action of the price bars themselves. Which side is price favoring? Volatility is an important concept to understand when using target. But what really is volatility? Volatility, as we define it, is the amount of price movement as compared to similar periods of time. If you're dealing with 10 bars in one section of your chart as opposed to 10 bars in another section, how much difference do you see a price change from a high to a low? Is the variation 10 points or 20 points or more? The comparisons give you the amount of volatility. Comparisons can be made using a single solitary bar against another single solitary bar, or any similar number of bars desired, as long as the duration is the same. The greater the price change with any given period of time, well, the greater the volatility. Again, if you're dealing with 10 bars, and you see 10-point change, as opposed to another section of the chart that has 10 bars, but there you see 30 points difference between high and low, well, obviously the latter has greater volatility. Volatility changes will in fact impact the targets that you set, and this is where it's important to understand this concept of volatility. Targets, well, they tend to be exceeded with greater volatility. In comparison, targets that have less volatility, well, they tend to come up a little short. Why do changes in volatility occur? Changes in volatility are caused by a number of reasons, including these 5 major factors. 1. Changes in participation. Well, this is common sense. As you have a new influx of participants in a market, well, naturally the volatility will increase to follow that participation increase. If you have participants lose interest and leave a market, well, then obviously the volatility will also decrease as well. 2. There is a natural cycle of volatility. Volatility tends to follow a normal path, although each market will be different and each market condition will also vary. Typically, the cycle runs this way. You will have a market decrease to its bare minimum of volatility. Something will happen and volatility will spike back up to a very high level of volatility and over time decrease gradually down to its bare minimum once again. At that point, something will again happen to spike up volatility once more. So it goes from a high level of volatility, decreasing gradually over time to a bare minimum, and at that minimum, again something will happen to spike it up to its high once more. The third reason for changes of volatility is in order to establish equilibrium. Every market that has any volatility will have some point where there will be a limit of buyers and sellers. In other words, you'll run out of buyers and sellers who can actually trade the market. They're all in the market looking for their expected move. When that happens, the market has to react by establishing equilibrium, because the only reason for a market to move is that there are buyers and sellers. Without that full amount of buyers and sellers, then you have a problem, and it has to decrease volatility and shake out those that are already in the market, at least enough so that you have a fresh batch of buyers and sellers to re-enter the market once more. The fourth reason for changes in volatilities is the news events and reports that come out. News events that are of major impact on a specific market, or reports that are either very good or very poor, are going to have a dramatic impact on the volatility, typically increasing it dramatically. The fifth reason for changes in volatility is the fact that a major impending report is about to come out. Because of not knowing the result of that report, buyers and sellers would tend to hold off their trading or reducing their participation as they wait for the results of the report. When the report comes out, obviously it will have an impact if it's very positive or very negative. But before that report comes out, volatility will decrease. Another factor that will impact your targets and whether or not price reaches it is that of market bias. Now, market bias is simply this: whether or not the market is favoring one direction or the other, higher or lower. This is where you see the market trending. Whether or not the market reaches its targets in one way or the other can tell you much about what is happening in the market, and because of this, this plays a very important role in being able to get in and take advantage of the best trends and the most profitable ones. How does it work? Well, basically, what will typically happen in regard to targets is that with everything equal and normal, price will tend to hit its target as expected. But when the market starts to bias one direction or another, as we see here, the market biasing to the upside, what begins to happen? Well, first off, the targets in one direction, as you see right here, will come up short in regard to price. Price just won't reach it. In the opposite direction, in the direction of the market trend, price will tend to exceed that target, as you see right here. Again, coming up short in the opposite direction, and again exceeding it in the direction of the trend. Do you see the pattern? Basically, as a market begins to bias in a specific direction, oftentimes you'll get an early indication or warning that that's exactly what's happening, because the market would tend to come up short in regard to its targets in the opposite direction of the trend, whereas it's exceeding that of the direction of the trend. When you see these indicators where the market is favoring reaching the target in one side as opposed to the other, you have a very strong indicator that the market is trending, and you have a great opportunity to enter into the market to take advantage early on of a powerful trend. So how do we know the difference between a situation where volatility is changing as opposed to market bias? And how do we take advantage of market bias? Well, let's take a look at this daily chart of cocoa and look at a couple of examples. First off, let's take a quick and brief look at what happened in the market and then go back and see how market bias would have helped us. We can see that the market rose higher and then developed a consolidation. It almost developed a wide triangle pattern here, and then finally broke higher to peak and decline off of that. Looking at just this consolidation activity, there is much that we can tell in regard to targets. For example, if we took a prior low and ran it through the balance point, which is located here where the bar split occurs, we can see that we made a target to the upside right here, corresponding with the two lows that we see prior. But what do we see going in the opposite direction? If we take a target line through the balance point found here at the bar split in the middle of the pattern, what do we see? Well, we see that price stopped substantially higher than the target line. It never came close to it. This is an indication that the market so far is biased strongly to the upside. And how did the market follow up? Well, looking at the market, knowing this, you could have easily have entered right where the market started to move by using a trend line as a signal and taken a long entry here. But even if you were late and didn't recognize this, let's look at a few other signals and what we are able to determine. In regard to the balance point here, what do we find? Well, again, we are at target. In the opposite direction, what are we looking at? Well, with this small swing, all we have is the prior high going through a long bar. So we would center that through the long bar, and doing so would show that, well, again, we're short. We didn't make it to the target line. Again, a strong indication that we're strongly biased to the upside. A simple trend line or any other simple means for determining an entry, and at the break, again, you would buy, taking advantage of this nice strong swing to the upside. This bias factor can easily be seen because repeatedly we are hitting the targets to the upside but failing to reach them on the downside. This is an indication of market bias. This is a signal that tells you what you can expect. Now, it doesn't necessarily mean that the market bias will stay indefinitely. The fact is that obviously it's going to reach an end and turn around. Still, for the time being, in predicting what will happen and where the market bias lies, this is a great tool to actually take advantage of and get the opportunity to trade these swings before they occur. Market volatility, well, that's a little bit different. Market volatility would show up in another way. Market volatility, well, that's obviously quite different than market bias. You have a change in market condition from a very volatile or trending situation to that of consolidation where the market's compressing. In this market of corn on the daily time frame, we can see a number of changes occurring where we see consolidation, we see volatility pick up, a very strong swing where the market declines here, further consolidation, and the market picks up on volatility again and starts to trend some. Obviously, these changes do impact the way that you would want to trade a market. When you look at this market as a whole, well, you probably wouldn't want to worry about trading a market right here because very little activity occurs and it doesn't offer much of an opportunity for profit. In comparison, trading in the right direction, entering at the right time, you obviously would want to trade a swing like this because this offers a great profit potential in a very short period of time. Very robust market. Now, is there any way to know what the market's going to do and how it's changing based on targets? The answer is yes. Now, let's take a look at a few factors. Here we see a balance point right here. It is shown by the green candle within this trend or swing. When we take prior lows and run it through this target or balance point to create target lines, this is what we see. Now look at the difference between these points and what do you find? Well, the first point you see that the market, well, price exceeds it, nice and strong, and responds right away off of that, as you can see by the strong decline. The fact is that this is typically what we like to see in a market. It responds very well, nice strong volatile action, spiking through, and then reacting right away. The second target line, though, is just momentarily touched, as you see here. Now, this is still hitting the target, and the market reacts violently off of that and very quickly. So it's still a good target. However, there's an obvious difference between the two. One exceeds the target line. The second, well, just touches it, nothing more. When we look at the third target, what do we see? It doesn't even touch the target line. In fact, it's quite a considerable distance away from the target line. Even though the market still shows volatility and is reacting and responding very strongly. This tells you much about the condition that we're dealing with, consolidation. But at this point, well, that's not much advantage to us to know for certain that that's what's happening. Even back here, Even though this was where following this was the worst consolidation, we were already within a consolidating condition, and it wouldn't be that hard to read or recognize. Is there some way we could know earlier? The answer is yes. Look at some of the targets that develop very early on. For example, this target or this target through the balance points. What do you find happening? Well, in the first, you can see how far price is from the target line, a long ways off. In the second, again, the market fails to reach the target line, indicating that volatility is reducing. Even before this occurred, what do we see in regard to the swing itself? Well, let's move this up a little bit and look at the target based on the balance point. And what do we see? Well, again, price failed to reach the target line and instead consolidated. This change in the market tells you much about what you can expect about the upcoming activity of the market. An obvious point that we want to make in regard to reducing volatility before we get off the subject is that in regard to setting highs and lows, the market has a natural phenomenon where typically it will set highs and lows that following highs and lows will have great difficulty exceeding and will stay within a range. Now, sometimes you have a wedge pattern which may be inclining or declining, but still the highs and lows will still remain within the pattern itself, rarely exceeding that. In this case, we actually could set horizontal lines in place of these highs and lows, and you can see where the majority of it stays within that range all the way up until volatility returns. Now, even though it was broken and the market retracted, you can see how it has begun to trend following this, and the break of that helps to emphasize the point that volatility has returned. So this is another indicator that you can use in regard to volatility. We make this point because in consolidations, well, it's difficult to derive a profit because the swings tend to be so small. The obvious places to derive a profit from are the much volatile swings, and so that's the ideal situation. In any event, if you want to take advantage of the volatile swings, you still have to be prepared for them. And sometimes buying or selling within the consolidation is necessary, but other times it's just a matter of waiting for signs or indications that the market is starting to pick up its volatility once more. It's not important how you determine that volatility change, but the fact that you are prepared to take action when those changes occur. Naturally, you can also determine that volatility is increasing by means of targets themselves. Now, when you have an increase in volatility, two things are possible with regard to the market action and targets. In one case, the market may just simply be increasing the width of its swing. Thereby, targets are reached or exceeded on both sides. In other cases, it may be something a little bit different. For example, a trending situation is involved, and where one target is missed on one direction, it's exceeded on another, thereby indicating that the market is biased strongly in one direction. Both following a situation where the market had been decreasing in volatility or very compressed would in fact indicate that volatility is returning. To better understand this, let's take a look at this consolidation that we see just before this volatile swing that we've been talking about. If we look to the prior activity, what we see is a declining market, and it's followed by consolidation, and we start to move higher initially just before this strong decline. The volatility returned, as we see right here. The contrast is quite obvious, and there are a couple of things that do stand out in line with some of the things that we've talked about. For example, we do have a series of lows and highs that are established, and at this point it's clear that we have broken out of that, so a clear sign that volatility has increased. Now, most traders would see this as an indication the market was going to move higher. But how about us in particular in regard to using balanced targets? Well, let's take a note of a couple of factors in regard to targets and see what we find. First off, in regard to the consolidation, you can see that when we take a target, as we do here, we find that as it's consolidating, the targets fail to be reached. They come up short because volatility is decreasing. But as soon as we get a little further, note what happens here when we take a target in the opposite direction. We find our target is not only met, it's slightly exceeded. What's even more important is the fact that even though this backed off, it resumed that move and went way beyond the actual swing. When we look at it from a mathematical standpoint, we can also see this as we set up a target this way. And again, we see our target is met, but again, exceeded very strongly, indicating that there's volatility on the rise. Now, was this just market bias for an increased move upward, or just an increase in the swings themselves? Well, when we look at the targets again, there's one other thing we note based on this balance point. If we take this and run it through that balance point, what do we end up with? Well, we end up with our next balance point, where an inverse occurred. Obviously, looking at this as it swung higher, we had a clear indication that the market had to come back down at least to this point, and so we had a great shorting opportunity. All we had to do was set up a trend line or some other means for signifying or signaling our entry into the market to short this. Once it reached the inverse, it was clear by means of the way that the bar established itself as to what was happening. And if we had exited, clearly we would have re-entered when we saw that the market was breaking lower, thereby establishing a further profit opportunity for us. Now, these things that we talk about in regard to the targets establish one thing that is clear. When you start to see inverses appear, or the market exceeding its targets, well, in fact, the volatility is returning or increasing. When volatility is increasing, then it's time to seriously look at a potential trade, because this is the time when the potentially high profit opportunities start to produce themselves. One additional tool that we would like to mention in regard to helping you determine whether volatility is increasing or decreasing is a simple tool that most traders are familiar with, and that is the trend line. If you draw a trend line when a market is trending, and of course in a more volatile situation, the tendency is that the market, once it breaks that trend line, will result in a consolidation pattern, at least for a time, and of course lower volatility. This is repeated time and time again as you set up a trend line. As you can see here, for example, again, a consolidation forms once that trend line is broken. This also works the other way, because a consolidation tends to follow certain patterns. Many times it is horizontal, and so therefore you can simply draw a horizontal line, setting up the parameters of the consolidation pattern. And as it begins to break, well, typically it brings with it greater volatility. Sometimes it can be a pattern where you can actually draw a trend line to it, and in the process developed a pattern that may be a small channel, a flag, or even a wedge pattern. When those patterns are broken, well, then typically they bring with them greater volatility. Now, for those who trade patterns, you recognize this principle, but it's quite useful for our purposes as well, because the key is that when volatility begins to increase, well, it typically brings with it the more profitable trades, and therefore the ones we want to take advantage of. To summarize the things that we've learned so far, anticipating lower volatility, we look for specific signs such as 1. Failure to reach short-term targets. 2. A trend line break. 3. Failure to exceed prior highs or lows. And 4. The formation of similar highs and lows. In anticipating higher volatility, Typically, what we look for, the signs, are 1. Short-term targets are exceeded. 2. Target exceeds high or low range. 3. Consolidation pattern is exceeded by price. 4. It fails to return inside the consolidation range. And finally, 5. New highs or lows are set by price. Balanced Dynamics video number 3. Understanding wave flow, inverses, and volatility. All methods and techniques are those developed by Michael J. Parsons. The videos are narrated by Michael J. Parsons. Director of Marketing, Osman Musa. Technical Support, Melissa R. Parsons. Accounting, Ruth E. Parsons. And Translation, Heather L. Parsons. This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization.